You're muted, Peter.
Well, thank you for that, Marty. I'm muted. Technical glitches every time we turn these sessions on and off. Welcome back to KoreConnect's Real Estate Jobs Act and Tokenization Summit. For today's afternoon session, we're going to be continuing on a little bit of a departure from Reg CF and Reg A and the investor community from the public at large and the crowd. And we're going to focus on a little bit more on what regulations should we be used for real estate for the accredited and the institutional investors, and focusing on Reg Ds and Reg Ss and where they fit into the landscape. It's my pleasure to have two experts in their field of securities, tokenization, real estate, and most importantly, the law and the ever-changing regulatory landscape. I'd like to welcome Marty Tate, partner at Kunzler, Bean and Adamson, and Tyler Harttraft, partner at Bull Blockchain Law. There's a tongue twister. Good to see you both, and good to see you again from yesterday, Tyler.
Yeah, thanks very much for having me, Peter.
And Marty, welcome. I know we've had with KoreConnect's relationship numerous conversations, and your guidance and tutelage as far as regulations go and the ever-changing landscape are very, very much appreciated. So welcome, and it's a pleasure to have you here. I want to jump into the last session we talked fairly extensively on Reg D, but I think it's super important to go over Reg Ds and Reg Ss. We wanted to touch on it today. Reg Ss are used a little bit less frequently since the adoption of Regulation A+. But I'm going to turn it over to you two, and maybe give me a bit of the definitions and the differences between the Reg As and the Reg Ss, and what the filing requirements are from a legal perspective. Who wants to take over on that first question? Marty, you want to jump in on that?
Sure, happy to. Yeah, so a Regulation D is a safe harbor private placement exemption. It's an exemption from registration. It's like I said, it's a safe harbor that basically consists of a few rules, the most common of which is Rule 506, the most commonly used. And it basically says if you meet these requirements, then your exemption or your offering falls within the safe harbor of a private placement and does not need to be registered or is exempt from registration. And like I said, for traditional real estate financing and probably financing in general, it's the most common exemption that's used to raise capital. Think of your a real estate fund or a real estate syndication or even a private venture capital fund. All those are going to typically rely on a Reg D exemption.
So you touched on 506C, which is I can do general solicitation. I think but I also hear the term 506B. And there's a difference between the two. So maybe you can give the audience a little bit of a quick overview on that, the pros and the cons. Tyler, you want to jump in on that, or Marty, other way?
Go for it, Tyler.
Yeah, sure. So yeah, 506B is quite different in that it allows you to raise money from non-accredited investors, up to 35 of them. But the big kicker is that you cannot generally solicit. So you're not able to go out and advertise, use a website, social media marketing, anything like that. It's really an exemption that's primarily used by individuals who have pre-existing relationships with investors. It's also referred to as the friends and family exemption. So to the extent you want to bring in people who are not accredited, it provides an opportunity for that. But the majority of raises that we see and that are ongoing out there in the market are your 506C raises.
And the 506C were limited to 2,000 accredited investors before I'm fully reporting. That's my understanding?
Yeah, and not so much an offering restriction in that it's a separate restriction that applies to all companies. Once you hit that 2,000 investor threshold and a 10 million in assets value, then that 12G Exchange Act regulation kicks in, and so you have to become a reporting company. But you have to meet both prongs of the test.
So we know that a 506C, I can do general solicitation. What are some of the parameters around a general solicitation? What do I need to disclose? What can I say? Can I not say? Where can I do that general solicitation? Marty, insights on that?
Sure. So the general solicitation, and this was a big deal when it was included as part of the Jobs Act, because what it did is it expanded the ability, in doing a private placement, it basically allowed people to advertise it and market that offering. Primarily, most of that advertising is done over the internet through web pages or internet or ads or so forth. But really, there's no limitation on where those can go. You could have it on the back of a plane. You could have it on a blimp. You could, billboard, TV ads, radio ads. I think I've seen and heard it all. With regards to what you can say, that you're pretty wide open there as well. There's no general restrictions on what, or specific restrictions on what can or can't be said, other than you have your you can't say anything that's misleading. You can't say anything that's promissory. We strongly advise against certain graphics that show, arrows going up on your return on investment. Anything where you're being, again, promissory or talking about, 2x on your return or 10x on your return, anything like that would be frowned upon and could be deemed a violation of the rules associated with that offering. But again, it's not specifics.
So you can be forward thinking, but a lot of common sense, applies. I'm making an offering and I'm showing a castle and I'm selling residential real estate, and that might be misinterpreted that I'm actually investing in the castle, and there may be an obvious visual example of misrepresenting the offering. So from a marketing, so that's one of the beauties of a 506C is that ability to say, hey, I can go after the public at large, but I'm going after the public accredited investor at large. So that becomes often the challenge for, I think, the investors or for the issuers themselves, is to say, do I have an offering, and am I willing to spend enough time articulating my message and touching those investors on an ongoing basis in order to make my offer compelling at the end of the day. From your experience, and we're going to be jumping into the institutional and the family office side of it. What's been the I guess the general approach? I know this is you're both in the legal side of it, but can you share some insights or experiences with what companies are doing when they're trying to present their offerings to those accredited investors, and what the approaches that they might be taking?
Yeah, happy to jump in and share some approaches. I mean, we have clients who certainly want to, put their best foot forward as far as communicating the investment prospects or the prospect of returns, but without running afoul of saying too much or saying something that might be misleading and getting into trouble where there might be omissions. And so what the exercise that we work through with our clients when we're talking about or reviewing the marketing materials is really, if you are going to provide numbers or projections or past history, how is that calculated? Are there any caveats that need to be mentioned as far as how the numbers were derived? And then do we, to the extent that there's communications around those numbers. Are we leaving anything out that would subject us to misstatements or omissions liability, as Marty was referring to? And it's just usually a review and discussion for those marketing materials, and making sure that there's no holes in any of the information that's being presented to the investors. And like Marty said, it's largely common sense, to the extent that it's not false and not misleading, you're generally going to be in the clear.
So when it comes to real estate, and we'll go over to the Reg S's a little bit later, but when it comes to real estate and structuring the deals for a Reg D, where do I begin? Let's say I'm new to this, and I want to. I've got a development project, and I've got shovel in the ground, and we're going to do a residential property, for example. What kind of questions do you ask, and where do I begin? Marty, you want to weigh in on that?
Yeah, sure. So typically when we have a client that's wanting to do a new offering, the questions that I ask are, how much and from who are you trying to raise the capital? So in this situation, if somebody came and said, listen, we're trying to raise, we've got this real estate project, we need to raise $1 million of equity to go on top of the debt financing that we have lined up. So then the second question is, who? If they said it's a handful of accredited investors, and we know all of them, and we're just going to talk to them, then that kind of dictates what steps need to be done. If they said, well, we've got 24 or let's say 50 investors, half of which are accredited, half of which are not, that would drive us towards using a 506B. And I guess the other question is how do you want to do this? If they say, hey, we want to raise this capital, but we want to do it over the internet, we want to send out things, then that would dictate, again, what we would do, what exemption, using 506C. But that also would dictate, those questions dictate, what disclosures need to be provided. If it's just 2 or 3 people that are coming together, they're all accredited investors, the amount of disclosure, as a rule of thumb, might be less than if they're saying the other example where it's 50 people and some are accredited, some are not. Then the disclosures that you would want to provide to those investors would need to be ramped up accordingly.
Okay, so more detail for the non-accredited investor than the accredited investor, or maybe not detail, different?
Well, different, and it's not different. It's not different from what you would provide them. Everything, you have to provide the same information to every investor, regardless of whether they're accredited or not. But if it's 2 or 3 sophisticated accredited investors that come together, they probably don't need a full private placement memorandum with pages full of risk factors. They're presumed to understand the risks associated with that. However, the more this is just kind of my rule of thumb, the more investors and especially the greater the number of non-accredited or less sophisticated investors, the more information the company is going to want to provide them about the project, about the company, about the risks, financial information, all of that, so that if nothing else, it's like an insurance policy or a pseudo insurance policy. It's
sure.
You wouldn't have them come back and say, well, you didn't tell me X. The purpose of that private placement memorandum or disclosure document is to say, well, we told you the risks, we gave you the financial information, we told you all these things. So
you want to broaden the information. Yeah, no, and that makes perfect sense. Broaden the information that's being disclosed, not necessarily disclosed, that you're articulating to a wider audience versus one individual or 2 individuals, is what I'm hearing, which makes good sense. So Reg D, it's a U.S. exemption. Have to prove that I'm an accredited investor. could be a letter from my CPA, for example. I mean, we do that from a technology perspective just to try to make it streamlined and easier. But now I'm seeing we have clients that are doing a Reg D and a Reg S simultaneously, for example. And there's a variety of online restrictions that are associated with that. Tyler or Marty, do you want to weigh in on the different? Let's start with the regulation. We know what a Reg D is. Let's talk about a Reg S.
Yeah, happy to comment on that. So Regulation S is an exemption used to offer securities to non-U.S. individuals in offshore transactions. So that means the individual is not defined as a U.S. person under the Securities Act, and they're not residing in the U.S. And that exemption can be used in parallel with other exemptions like Reg D. So you might have a combination exempt offering whereby you're offering to U.S. investors under Reg D and you're offering to non-U.S. investors under Reg S. And there's some additional particulars. The Securities Act is very meticulous. There's often clients that think of perceived workarounds, like what if I open a company outside the U.S.? Now it's, I have my BVI entity, and that's a non-U.S. person. But the Securities Act has forecloses those loopholes, things like that. So if you have an entity that's wholly owned by a U.S. person, that entity is going to be considered a U.S. person for the purposes of that exemption. And so it is a great tool for purely offering to non-U.S. investors and stacking it with a Reg D exemption. But, in addition to having an exemption that applies in the U.S., if you're an issuer based in the U.S., you also need to be aware of the offering rules or the private placement rules in the jurisdiction that your investors reside in. So if I'm offering in Germany or the EU, I want to be aware of the private placement rules in those jurisdictions to make sure I'm not running afoul of non-U.S. laws with my offering. And so, we've done, especially in the context of digital securities, we find a lot more interest from issuers in wanting to expand their prospective investor pool by offering to non-U.S. jurisdictions. And so that requires some analysis of those additional offering laws. And if you want to offer globally, you can imagine that's a pretty tall task as far as trying to comply with all of those exemptions. There's no standard rule, but there are a lot of similarities across different jurisdictions.
Okay, so I've got for my neophyte side of the regulations. So I've got a Reg D, it's a U.S. regulation. I've got a Reg S, it's a U.S. regulation. The Reg S is for foreign investors coming in, but the issuers should be aware that exemption may have some qualifiers on it based on where those investors are coming from, is what I'm hearing. Mm-hmm. Correct?
Right.
From your legal perspective, I've got a real estate project here. I want those foreign investors. I've decided I'm going to do a Reg D. Do I just say, let's do a Reg S?
I guess it would depend on like Tyler said, the scope or the reach of the issuer and where they want that offering to go. Like you said, in connection with digital securities, especially, that does make it, these sort of, our geographical boundaries have less meaning than they did in the past. And so people want to say, hey, we want to allow anybody to invest. And one thing that Tyler said that I want to just reiterate is that Reg S is great. Basically, that's the exemption for the issuer here in the United States. And what it basically says is it's the SEC saying, we're here to protect U.S. investors. So if you're an investor in the UK or in Singapore, we're not here to protect you. However, those countries have their laws that are designed to protect their investors. So if you are making a selling effort if you're targeting investors in these foreign jurisdictions, it is wise to make sure that you are also, like Tyler said, complying with the private placement exemptions and rules and regulations of that jurisdiction. So Reg S doesn't really have qualifiers on the US side, but the qualifiers are on the
foreign side.
The side of the foreign jurisdiction.
Okay, so it's probably, I'm going to make an assumption, maybe not 100% accurate. If I've got a bunch of known investors that are like a lot of funds may have, they say, hey, I've got my accredited investor pool, and some are foreign and some are domestic. I'm in a much better shape because I might say that I know the jurisdiction that my foreign investors are coming into the Reg S. So those are often just repeat investors, and if I know those investors, it just makes my life a whole lot easier doing a Reg S and a Reg D simultaneously.
Yeah, presumably, however, say there's 15 investors in there, or 20, or I think the larger the number, the more attention you probably want to pay to this. But if there's a number of investors and it is in a jurisdiction where you kind of repetitively solicit and obtain investments, you definitely want to make sure that you're complying with those laws. And so, for example, doing that, let's say a Reg D offering, and then you want to do a Reg S in Canada, that's great. But Canada, and specifically each Canadian province, has their private placement rules and prospectus delivery requirements and rules for their exemptions. So even if you know the investors and have done deals with them before, you want to make sure that you're complying with that law so that you don't run afoul of the regulators there. And even though you might be 100% compliant in the US, the Canadian regulator might have an issue.
No, and you brought up a really good point here. Being a resident of Canada, there isn't a central governing body that's got, like the SEC in Canada. It's each provincial jurisdiction. So, and rules change all the time, and that's the tricky part. And that's why you guys get paid the big bucks to manage those changes all the time and keep everybody aware of what's going on. Because you're right, what goes on in Ontario today, and I see this and what goes on in Ontario a couple of years ago, or Alberta, changes. So they may say we're comfortable with that investor investing in, whether it be a Reg A, whether it being a Reg S in the United States, can change. So really, really important points to note. And the real reason that we're strong advocates, not only from an educational perspective, but also from really recommending that any issuers, especially when they're having the conversation, whether it's a CF, a D, or Reg A, to speak to folks like yourself specifically to say, get the best guidance, because you do it all day long, because it's tricky. It's a tricky landscape to navigate. When it comes to Reg Ds, for example, and we've talked about, things like the hold periods, and I've heard individuals have come to me and say, they're freely tradable after freely transferable, or I can do whatever I want after a 12-month window. That's not accurate, is it? I mean, fundamentally, it's accurate, but if I'm a GP, I can write whatever I want in my offering, and the 12-month window isn't just it's a date without doing additional amendments to that. Would that be a correct statement?
Well, so happy to comment on that. I think, if you are not an affiliate of the fund, you're going to have a lot less restrictions on the transferability. And so under the Securities Act, if you did an offering under Reg D, generally you will be able to trade that asset after 12 months, assuming, like you said, there are no GP restrictions baked into the operating agreement or the limited partnership agreement. And to the extent that, you know, you're an accredited investor, you can usually sell that asset to other accredited investors even sooner than the 12-month lockup period, provided other requirements are met. And so it is relatively flexible. And, you know, to comment on Reg S a little bit, it's even more flexible as far as the transferability. There's three different compliance periods or holding periods for that asset. And the period that applies really depends on the nature of the asset being sold and the issuer that's selling it. And it's a tiered compliance period structure that is set up to prevent flow back to the U.S. So issuers with the most likelihood of their assets flowing back to the U.S. are going to have a longer compliance period. Issuers where the SEC is deemed that it's a much lower risk of the asset, the investment flowing back to U.S. purchasers, it's going to have a much shorter compliance period. And so Reg S also has some compliance restrictions depending on the status of the issuer. And that's something, obviously, with digital securities, we're very focused on when we're talking about looping in non-U.S. investors for the offering and what their potential for liquidity will be with those distribution periods. Excuse me.
No, thank you for that. Define digital securities in the sense that for this discussion point that we're talking about here. And you're referencing, go ahead.
Right. Yeah. I mean, I just mean it to, you know, the way I explain it is it's a technology overlay of an underlying asset. So, and the underlying, I mean, the direct asset, the limited partnership interest, the LLC unit. The ultimate underlying is a property in this context, but the digital security represents one of those interests. It can represent a share of stock, although it typically doesn't, given we're using pass-through structures for real estate. Right now, and I saw one of these comments flow by, I think it was yesterday, what is the point of using blockchain to represent these assets? I mean, right now, most of what's being done with digital securities is just a courtesy copy of what exists on the books and records of the issuer. It's not a bearer instrument, meaning you can't show up with that token and say you own it unless the books and records also reflect that. And the point of blockchain in, you know, decentralized context is the instrument is actually proof of ownership, or whoever owns the wallet that has, you know, access to the instruments via their private key is the owner. And the reason we can't make that happen right now is largely because of regulation. The SEC put forth the special purpose broker dealer requirement that says if you're going to allow brokering of digital assets, that's the only business that you can be in. And so all of the brokers in the space have licenses currently for other activities, and there really is no special purpose broker dealer out there as of yet that I'm aware of that's been approved for just handling digital assets and is solely dedicated to that. And there's been lots of commentary in the industry on that issue, and, you know, we're waiting to see if it'll be changed so that any broker dealer can allow for the trading of digital assets to really use the technology as it's intended to be. But for right now, we still have transfer agents that are recording the books and records and keeping the ownership records for these assets. But the whole goal is ultimately we'll get to a point where the asset is the bearer instrument.
No, I that's probably the clearest that I've heard that. I think we know where we wanted to end up, and the challenge is, if that's the case and the bearer of the asset controls the asset and the concept of it's on this immutable ledger, where does it break down? I mean, where does it, you know, we see the failings of the exchanges by not having a third party intermediary or themselves, you know, somebody, you know, who's watching the store, so to speak. Where do you see that playing out? Marty, what's your thoughts on that? I mean, we'd all like to have this, I think, personal digital asset world, but if you don't have a third party, and hey, let's be honest, at the end of the day, we have rules and regulations, whether in compliance and the SEC, whether we like them or not. But if a security is a security is a security, and we try to cross those boundaries, where does that land?
Yeah. So I think that Tyler said correctly that, you know, we're still waiting. I mean, the regulations are creating some roadblocks. Some of the roadblocks have just been meshing technology with the regulations, and I know that like initially when we were trying to do issue digital securities under Regulation A, that a lot of the comments back from the SEC related to just, you know, how will this work? Tell us how the transfer agents and how do you, and the pieces weren't there, which I think they're definitely coming online, and we're in a different spot than we were 5 years ago. But I think that, you know, the name of this conference is Real Estate Jobs Act, Tokenization equals Liquidity. I think that's representing these securities, whether it's debt or equity interests, is that's definitely where it's going. And I think right now, creating this this record of it on a distributed ledger has benefits, but it, like Tyler said, it's not a bearer instrument. It doesn't give you the ability to go and claim anything. You know, it's just a replica or a duplication of what should be reflected on other records. But I still think that there's a future in it. And I think that you're seeing more and more, you know, the tokenization of more and more assets, and, you know, by tokenization meaning just the ownership of that being represented in a digital format.
And no, yeah, so I think it's just, we're still at that nascent stage, and maybe sometimes we want to get from point A to point B faster than both technology and the regulators are ready for, and you know, so, but, and as we talk about the nature of this week on the real estate, you know, trying to put some clarity, I guess, when we talk about, you know, fractionalization, tokenization, digital assets, securities, combine them with the regulations. Fundamentally, we live in a world of rules around these regulations and these exemptions that we're talking about. And in order to comply with them, we can't necessarily do things that somebody might want to do. And I tend to, and I want your thoughts on this, I tend to make a comment, and when we get a lot of issuers or a lot of entrepreneurs that come to us and they say, hey, we want to use your tech platform in order to do this offering, and we want to tokenize the offering. And we say, what does that mean to you? And they say, well, I want to be able to digitize my asset, and I want to put it over here, and I don't want anybody else to have visibility to it, you know, towards it, except for myself. And the problem, you know, we articulate is, maybe I'd like that too, but if you don't want to run afoul with the SEC, and often the commentary is, well, they're doing it over there. And I think that's probably the biggest mistake that anyone can make. Just because somebody's doing it over there doesn't mean it's legal and compliant. And maybe we're going to get there, and I think we will get there, but it's just not today. Your thoughts on that? I mean, do you I see a lot of the SEC is going to clamp down, I think, harder in 2023, you know, based on trust and compliance than any other year we've seen. What are you hearing out there? What are you seeing out there? Or what are you advising your clients in that regard?
Yeah, I think we've certainly heard that story before. You know, we point to this person over here, and they're doing exactly what I want to do. Why can't I do it? And unfortunately, the lack of clarity it does not behoove those who are abiding by the rules of the road. I think, you know, as regulation starts to become more robust and more clear in 2023 and beyond, you know, those who have abided by the rules of the road, to the extent that they're clear, will be rewarded. But you're right, it does kind of create this race to the bottom, the lack of clarity for those who are operating in a gray area or just flouting the law with no repercussions. It serves no, it's a competitive advantage versus those who are actually comporting with with the rules. And so, it's a very frank conversation that needs to be had, and at a very early stage. And as long as I think we take a very practical approach, and there's situations where there is a lot of gray, and it's a commercial decision that comes down to the client's risk tolerance. And so we're always going to give, not only our opinion on the law, but, our opinion on the commercial risk and what that might entail. And so those are all things that we have regularly discussed with our clients.
No, well, thank you for that. We've got a question here from one of the viewers online, and it's more to do with the documentation for the SEC for Reg S offerings, and I guess that pertains. Do you submit any documentation to the SEC?
So there's no court. So with a Reg D, to have the exemption, you're required to file a Form D. Reg S there's no Form S that needs to be filed. So it's self-executing.
So, but that form must be posted somewhere. So where do we put it?
On a Reg S?
On a Reg S.
So there's no form. So it's just a magic. I don't know.
Good question.
Yeah, it's something that, so here's kind of how we approach it. So a Reg S subscription agreement is going to look a little bit differently. A Reg S disclosure document is going to look a little bit differently, and mainly address even, the holding periods, who you can sell to, when you can sell to them, or transfer. Those items need to be addressed. You would also want in the subscription agreement reps and warranties about them being a non-US person, where they live, and so forth. But none of those documents are filed. And even in a Reg D, the only thing that's filed is what's called a Form D, which is just a notice filing that goes to the SEC and as well as the states where you're selling. That just says we're doing a Reg D private placement, but it's not reviewed by the regulators, at least not for it's not reviewed and approved. It's something that you provide notice, but there's no corresponding document. There's nothing like that for Reg S. Okay.
But there are stringent requirements as far as who can actually access a Reg S online, for example, where the U.S. investor cannot access, only because we're in the tech space. So we have to look at this and seek legal counsel when we're assisting clients, where they're going to put a button for the application for the Reg S. It must be gated. There must be forget the technical term for it, but basically U.S. investors there's like a firewall. They can't see that button. Right? Geofence. Thank you, Marty. That was, yeah. So it needs to be geofence. Little things like that, to say I've got a Reg S button and I've got a Reg D button over here, and I'm doing everything. But there's a simple technical example. I need to geofence my Reg S button so that U.S. investors cannot be clicking on that and going through that offering. They got to go over to the Reg D button. That's all.
Which is an interesting, and maybe Tyler can weigh in on this as well, but it's an interesting nuance to that, right? So one of the issues to qualify for Reg S is you can have no directed selling efforts within the United States. And so this concept of having a simultaneous Reg D and Reg S, it's permissible, but it's also a little bit goofy, because just by saying that, I go to a website and I say I'm a U.S. investor and I can invest in the Reg D, but I'm not a U.S. investor. I can invest in the Reg S. What are those directed selling efforts? It seems to me if you have a website that a U.S. investor could access, that looks like a selling effort, but the that hasn't been the position with the SEC. So
yeah, hence the geofencing. So they say if you're geofencing it, we know you have a Reg S, but you're not letting me look. You're not letting me click on it. So I think maybe that's
Yeah, they kind of say if you're using another exemption, you're okay, but to the extent that you're not, that's a directed selling effort. And I wonder, I don't know offhand if that rule predates the ubiquitousness of the internet. Or if that's something that was more recent, but I'd be interested to know if that was something that was, really devised when it was more, mailings and paper advertisements and things like that, and it was much more needed probably.
Or it's certainly more easy to manage, I would think, or to
Mhm.
delineate. Jumping over to institutional, from a document requirements perspective, I mean, there's two different audiences here. I mean, the accredited investor investing in a Reg D versus what an institution or what a family office requirement might be. It's more on the institution side. Looking for some comments on that. I'm doing a Reg D offering and I'm soliciting for family offices and institutional investors. Differences, nuances, requirements?
Yeah, I'll comment on that and be interested to hear Marty's take as well. Because while a PPM is not required you're going to use Reg D most likely. And while a PPM is not required, it is somewhat of a best practice. Even, in our experience, even when there are large institutional investors, depending on the type of venture, you don't see it really in, private equity too much, but with respect to real estate investments, there's a lot of information to be disclosed, and usually the best way to do that is put it in an offering memorandum with risk disclosures that they're going to do more benefit than harm. There's no harm in providing them. And so we see still PPMs being used as a best practice, even with institutional investors. But it also, Marty mentioned this. It depends on the number of investors too. If we're generally soliciting, then we want to have that PPM available. But if we're just going to a couple of people that we've dealt with, and they're in the space, they know the industry, it's going to be hard to say that they weren't aware for them to turn around and say they weren't aware of the risks when they did, A, B, and C deal with you already, or in the same industry, or that's their niche. And so it's definitely a risk-based approach.
Okay, and that makes sense. So it's the more details you provide, really the wider your audience, and the more due diligence that let's say an institution or family office is going to require anyway.
And a lot of times a family office, or it's Tyler said, it's not required, but it is best practice. And a lot of times a family office or an institutional investor, as they're looking at a project, will say, send us your PPM. So it's also just kind of become part of doing business. So that's another reason that it's done. Now, it does provide some level of protection, but it's also a kind of the standard.
Okay.
Yeah, it's almost if they don't know you, it's a gating mechanism, really. I mean,
Yeah.
How polished is your presentation? How good do you look on paper? If you don't have one, or you send them something that's really not very robust, it's gonna they're gonna take that and judge a book by its cover, because they're getting lots of these. We assume, and it's kind of a gating mechanism in that respect.
You're giving them the reason to say no early on.
Right.
Okay. Hey, so in some of our earlier panel sessions, we were talking about sidecars between Reg Ds and Reg CFs and Reg As. Maybe you can share some of your experiences from a tech perspective. We do it on a regular basis where somebody's doing a CF and they say, I need to do a Reg D, and they're using an invest platform for the application. It's going to vary between who the investor group is, differing between the accredited and the non-accredited, or the hybrid of both. And then the offerings are different, somewhat different between the Reg D and the Reg CF or the Reg A when they're doing a sidecar investment. What's been your experience, and what's your recommendation in the real estate sector? Good idea, bad idea? You're casting a different net, but you are structuring your deals differently, in such that my CF offering might be different than my Reg D offering. Comments, thoughts?
Yeah, I think it can be a good idea, and it can be helpful. I think especially like with the CF, because you're limited to the amount that you can invest or you can raise under that exemption, whereas a Reg D you're not. So if you have, if you're doing a CF to try to raise, say you need $10 million, you could only use that CF to raise 5. You could have your accredited investors invest under a 506 or Reg D offering and come in that way. That where you have to be careful is that that because you are advertising your Reg CF, just by having a CF, you're deemed to be doing a general solicitation.
Mm-hmm.
You have to comply with not only you have to comply with those requirements, but your Reg D offering would therefore have to be a 506C. And if you're advertising, you have to take the higher law of the Reg CF advertising requirements, which there are limits or there are restrictions on what you can and can't say. So you can't say whatever you want over here to the Reg C to the 506C guys, and then the limited stuff here, it's deemed to be the same communications to everyone. So there are some nuances to that, but it definitely is something that makes sense.
Yeah, no, a super important point that you just made there. It's just make sure that you're clear to the audience that you're doing both of these, and it's perfectly acceptable. You're doing, hey, I'm going to raise 5 million here, and I need 20 million over there, and maybe I started a CF and I'm not moving into a Reg A right now, for example, and try to accommodate both of them. But yeah, no, that makes perfect sense. So yeah, I mean, from a legal perspective, I can have a CF and a Reg D and a Reg A all at the same time legally, can I not? Usually you see one rolling into the other, but there's no legal requirement that says you can't do all of them. I generally see one rolling into the other, but a Reg D is a sidecar to a CF and a Reg A potentially simultaneously when you're at different locations on the web for, going for those different audiences.
There's different requirements for each, and I think you just have to make sure you navigate through that. With the amendment to, a couple of years ago to Reg CF to allow testing the waters, that kind of makes it makes it less difficult because before you did a Reg CF, you just couldn't say anything. So now, that's one less bear trap to step into.
So one of the questions that comes up a lot, and I mentioned institutional, for example, or even family offices, was the old adage of, oh, I don't want too many shareholders on my cap table because they're not going to be interested in that. My takeaway from our experience has been not necessarily true. It used to be when technology didn't facilitate that, or the perception of I've got too many chiefs at the table, so to speak. So if I'm looking more in the VC world where I'm coming in and saying, okay, I want to be the lead and I want a seat at the table, and I don't want too many investors that can perhaps influence my position. But when it comes to the democratization of capital to the crowd, tech says, I don't know, we got 100,000 people on the cap table and they're common shareholders. Also says I might have a following and brand advocates and an audience. Do you see that dissuading any family offices in that regard if they're coming in on let's say different terms because they're a large investor into an issuance that they might like? Comments on that?
I mean, yeah, I think the issue you're highlighting is one of control, and in most of the circumstances we see, these assets or the interests don't have any voting rights attendant to them, and so what you're concerned with in the VC context, as far as a board seat and different control provisions and different rights for different investors, is not necessarily gonna rear its head in a lot of these real estate contexts where it's just an economic right at the end of the day, and absent any sort of abridging of rights, decision to abridge the rights of the interest holders, you're not going to need their vote for most of the activities, and so it's not really as much of a concern in that context.
And No, and that's what we've been experiencing some. But it used to be I never quite understood the context originally when they said you can't have too many shareholders, and back in my mind I'm going, I don't know, I've never said that in a public company, you know. So
Well, you might, yeah, it might be a reference to that 12G rule that we were referring to with the 2,000 investors. You know, lots of companies want to avoid that public reporting requirement that comes along with having that many investors if you also have the requisite amount of assets.
and that makes, well, let's elaborate a little bit on that. So we talk about that fully reporting on a Reg D after 2,000 investors, or the asset threshold. When it comes to, I'm doing a Reg CF, I'm doing a Reg A, I can have unlimited number of shareholders. When a Reg A, you're still reporting, but give me some insights on the different types of reporting as a fully reporting company in relationship to the different exemptions.
Yeah. So, and maybe this has been touched on in other sessions, but a fully reporting company is a company that is required to, report under the 34 Act, and that's what we deem as a public company. And they're required to file annual and quarterly reports. They're also required to file, statements of ownership changes. There's a lot that goes into that, and so it's
a big process.
That's the highest. Well, not the highest, I guess. If there's other types of reporting companies that you have to do more, but with a Reg A, you're pseudo public in that you do have to make you have to file an annual filing and a semi-annual filing, but you don't have to do quarterly reports or ownership changes. And then with Reg CF, you have to do an annual update on the company. So it's tiered, definitely, and but it's also advisable to, unless you want your stock to change or to trade on a exchange or a market, and most companies try to avoid being a public company.
No, and fully understand that from a reporting. It's not really the number of shareholders then. It's if I'm using certain exemptions, I'm reporting in some capacity on a CF, on a Reg A. It's just the level of reporting that I'm actually doing is what I'm hearing here.
Yeah, and that trigger, as Tyler mentioned, the 12G trigger is based upon assets that the company has and the number of shareholders they have. However, Reg A and Reg CF provide an exemption from that reporting requirement from becoming a reporting company. Reg D does not have that exemption. So if you bring on, yeah.
Go ahead. I was just going to. So it's another reason that everybody says Reg A plus is probably the best exemption that exists today, if you're prepared and it suits your appetite for the raise and the due diligence for the filing. Would that be a fair assessment?
Yeah, it's definitely
flexibility.
It's a good. It provides a lot of flexibility, but it's also more expensive and it takes a lot longer than the other two. So
now, it sounds like, and I think we're getting to the top of the hour here. They all have a purpose and they all have a home at different stages. And they're just more opportunities for individual companies today to look at what their options are. And by speaking to Tyler and Marty, they can give you some infinite wisdom on strategies and structure early on, rather than jumping into one or the other or all three. Would that be fair?
Absolutely.
Yeah, absolutely.
Well, I want to thank both of you. Every time we have these sessions, if you can get one good idea that came out of it, I think they're invaluable, and I always get a great new takeaway, and I always learn something. So, Tyler, Marty, I want to thank you, and I want to thank our online audience for sitting in and participating. Until tomorrow, wishing everybody a great afternoon. Thanks so much, guys.
Thanks for having me.
Thank you.